In this podcast, I'm going to take you through 5 ways that you can boost your superannuation fund quickly and easily. Stay tuned if you want to unlock the greatest tool for your retirement. Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. The first thing I want to tell you about is probably the most important, and it's easily the most confused thing when it comes to superannuation. If you've ever heard someone say, I'm with AustralianSuper or HostPlus, and I think it's expensive, they're actually making a fundamental mistake in understanding how superannuation actually works and the fees that get applied. To explain this, I'm going to run through a couple of examples with you. If you're an AustralianSuper member, as around about 2 million Australians are, you can just head to their website and you can find something called the product disclosure statement. If I'm being honest, the big super funds try to make things simple, but in doing so, it becomes incredibly confusing and you end up with different documents for every different thing. If we head to the AustralianSuper website, one of the things and one of the mistakes that people make is when they go to like the superannuation fees and cost pages, they can click on the page and find out roughly how much they might pay with like an online calculator or something like that. But the bit that they don't really understand is how the superannuation fees apply at different levels and different options depending on what they're doing and where they're at in their life. So just for example, here in AustralianSuper, I can see that if you have a super account, you have a flat administration fee of $1 a week, so $52 a year, and an asset-based administration fee of 0.1% per annum of your account balance, up to a maximum of $350. So let's assume we've got the maximum, $350 plus $52, it's about $402 a year. Now you might be thinking, $402 a year doesn't seem that bad, right? But then if we go down to the most important option that you will make in your superannuation fund, or the most important choice that you will make, we have the investment fees. Now, these fees are fees that are dependent on which investment option you select. We've got an entire course on this, on covering the basics of superannuation, where I explain the different options and which ones maybe you can think about choosing. But you can see here that AustralianSuper says on their website, and I'll quote, "For our pre-mixed and DIY investment options, investment fees and cost vary between 0.05% and 0.53% for accumulation and TTR income accounts, and between 0.05% and 0.58% for choice income accounts of the amount invested depending on the investment option. They are deducted from the investment returns and reflected in the daily crediting rate." Let me just break this down for you. So depending on which option you take, whether it's the balanced one, the high growth one, the socially aware one, whatever option you take, your fees will vary. So you can probably automatically see why if your friend says, oh, I want to change to a low cost super fund, well, that's probably not the right thing for them to say. What they should be thinking is, do I need to change my investment option within my current superannuation fund? Because we know that fees play a massive role in what you ultimately end up with inside your superannuation fund at retirement. And so we can see the difference just here in AustralianSuper between the lowest cost one, which is 0.05%, and the highest cost one, which is 0.53%. I don't know about you, but doing some quick math, that's 10 times the difference from the lowest cost to the highest cost. Now, fees aren't the only thing that you need to consider. So I want to just take you through a bit more of an example and help you understand. So if we now switch to the HostPlus superannuation provider, another very popular one in the Rask community, we can see that they've recently issued an update to their product disclosure statement, or PDS. It's here in a PDF format for you. So PDS is the product disclosure statement. And here's the table that you want. And if you're watching, this is great. We'll try and get this here for you. But if you're are listening, I'll try and explain it to you. So basically, they've just got this big table where they've updated all of the different investment options down the left-hand side and the different fees that apply throughout the year. So we can see here, if we just take the balanced option from HostPlus, we can see if we go right across to total investment fees and cost, the balanced option for HostPlus is 1.1%. Let me just break that down again. The balanced option from HostPlus is 1.1%. Now you're probably thinking, hold on a second, I read the Barefoot Investor book and he said it was one of the cheapest ever. Yes, because he wasn't talking about the balanced option, which most people end up in. He was talking about another option further down the page, and I could be mistaken. I don't want to take the words out of his mouth, but I believe in his book he talked about the index growth option, which is 0.02%. Now, let's just do some quick math again. The difference between 0.02% and 1.1% is over 50 times. So some people that go, I'm just going to switch to HostPlus, end up in the option that's 50 times more expensive than the one that they thought they were getting. So clearly, it's not just about which super fund you go with. Perhaps more importantly, it's which investment option am I taking and what are the fees that apply for that investment option. But again, I don't want to just focus on fees. You can see if you're watching, there are so many different options at HostPlus. Just a quick eyeball of this, there looks like there's 20 different investment options and there's 20 different fees. So you can get a sense of how confusing this might be. But let's say, for example, we just put into Google HostPlus investment options, right? I should also say that some fees are good. I would rather pay fees for a good super fund than pay very little fees for a bad super fund. So I just want to make that clear. I'm in a super fund that's more expensive than the 0.02% option for those of you that want to know. All right, so now we're going to look at a real life example of the different investment options and the fees versus returns over time. So we're here on the HostPlus website again. Scrolling down, we can see the net returns, net meaning after the fees and costs are taken out, of the different investment options like growth, high growth, etc. through time. So if we look on this page here, we can see the growth option from HostPlus. This is the one I was just talking about, 10.9% per annum in net return over 5 years, and that's at a 0.93% per annum fee, right? But let's go to the balanced option and let's use this because this is the one I kind of raked over the coals just a second ago. So we talk about the balanced option. This is the My Super option. Anytime you see My Super inside a superannuation fund, basically that's like the default option. That's like the one that most people go into as a default. It's not always the case. You can change it online or in your own app. But say, for example, we're here in the balanced option and we're looking at this. We can see this again has a fee of 1.1% per annum. That's investment fees and costs. And if we follow the asterisk down here, total investment fees and costs are based on the previous financial year. For a full breakdown of fees and costs, visit the fees and costs page. So I might just quickly jump over to that and just have a bit of a look here. And we can see there's also an administration fee of $78 per year. Okay, so back to the investment option of balanced. Over 5 years, the net return after fees is 10.28%. So this is the higher fee one that I mentioned before. So that's after fees. So that's a pretty good return. Now, past performance is not indicative of future performance. I like to say that that history may rhyme, but it doesn't repeat. So even though a long-term track record can look really good and we say it's not necessarily indicative of the future, if you get a long enough track record, I think it's kind of rhymes, but it may not repeat. So 10.28% for the higher fee option. Let's now look at the quote-unquote cheaper investment option. That is the balanced option, the indexed option. So indexed balanced, which is the cheaper option, right? You can see 0.03% in fees, 9.45% return. Now, I know podcasts aren't great for numbers, but just hear me out here. What I'm saying and what the data shows is that the cheaper option, even though it's cheaper, which means good, it's actually done less than the one that has a higher fee, which means bad, right? So how does that work? is because fees are not everything, especially when it comes to superannuation. Yes, a fee of 0.75% or less sounds pretty good to me, but you need to know what you're getting. Is it apples to apples? Is it apples to oranges? Like, are we comparing an index fund, which hasn't done as well as the other one, or are we comparing it to an active investment strategy? So my big takeaway, and the number one thing, the reason why I wanted to spend so much time on this, is because this is the easiest thing for any one of us to figure out, is what are the fees that I'm paying, and is my investment option right for me? We have so many people come to us for financial advice or ask us questions about which investment option. Your superannuation fund has really good investment information here to help you make that decision. Most people who understand investing go for the most growth they can because they know that they're not going to get access to the money until they're 65. And as they get closer to 65, they'll start to wind down the risk. So they go from 100% growth or 90% growth or 80% growth right down to a more balanced approach. That said, a lot of people who don't understand investing go into the high growth options because they think, well, look at the returns, only to find out that they just freak out at the next market crash. They sell at the bottom, then they go to the cash option or the less risk option. The stock market goes way back up. Meanwhile, they're still stuck in their cash account. And then they switch it back once, oh, things are better now. And they've lost all the money on the way down and gained nothing on the way back up. So if you're one of those people, get financial advice. Do not make a decision with your super fund based on this video alone. We've got a full free course, so go and check that out. I'll put a link in the podcast player or in YouTube. So that's number one. Just look at the fees and costs and look at the long-term performance after fees. Don't look at any track record under, say, 3 or 5 years. It's just, don't look at it, because any of those short-term performance, there's a lot of studies that show short-term performance chasing is an absolute recipe for disaster. Go 3 years, 5 years, or 10 years as a track record. That's what you want to be looking for. Apples to apples, remember that. So that's number one. And number two is just the investment option. Make sure you're an investment option that's suitable for you. So we've just discussed, it's not always the case that you want to be high growth, but most people in their super are tending to be higher growth. Just be aware that if you go to a high growth strategy, you may experience more ups and downs. Number three is pretty simple. In order to boost your superannuation, one of the simplest things you can do is add more to it. Now, if you go to our website, we have a full guide on how to add extra money to super. In fact, like, how do you actually add more money? What are the different ways that I can do it tax effectively, and so on and so forth? One of the easiest ways to add more money to super is to make what we call a concessional contribution to superannuation. I know that sounds like a lot of jargon, but basically what it means is once you get paid and you've got money in your bank account, you can then put some of that money back into your super fund and claim a tax deduction for doing so. Now, there are certain rules, and there's a threshold on this, up to $30,000 as of 1 July 2025. This $30,000 limit, and you can find out all the literature in the podcast player or what have you, this $30,000 limit also captures what your employer puts in on your behalf. So let's say for round figures that you earn $100,000 and your employer puts in 12% or $12,000. The $12,000 goes into your super fund. That means you've got an extra $18,000, the difference up to the 30 that you could put in. If you're under $500,000 in balance in total across super, you may be able to make use of the previous 5 years worth of unused caps or unused limits. That's a really good strategy for anyone close to retirement that hasn't been able to add a lot of money to super because of kids or because of a mortgage or because of a change in working circumstances, divorce, any other reason. If you've got under $500,000 of super, read our guide or speak to your financial planner to decide if it's right for you. That is easily the number one way to boost your super in the lead up to retirement. The fourth thing I want to tell you about is a free kick for literally everyone. The fourth thing is really simple. It's when, and I've got it here on the page in front of me, you can use something called a government co-contribution. Now, a government co-contribution only applies to people who have an income below $62,488. So $62,488. If you're below that amount, you may be able to add money to superannuation and the government will chip in some money as well. It's not like it's not like a, $1 for $1, but you may be able to put a little bit extra in, and then the government puts some money in as well. If you're anywhere between $47,488 and that's $62,488, it's kind of like this threshold where once you get to $62,488, it cuts off. So there's like a threshold. But if you're a lower income earner, this is easily the best way to just get some free money from the government. You can put a bit of money in and the government will top up a little bit extra. Even some of the most wealthy people I know use this strategy because they think, well, why wouldn't I just put some more money in? Makes sense. So this is a simple way to check out if you could, add some extra money and get some free money from the government. There are rules and specific criteria that apply to all of these things. So make sure you go and understand that, read our guide before you go and make use of any of these strategies. The fifth and final thing that I want to cover off, and this goes back to fees, but it goes back in a different way. A lot of people, when they look at their annual superannuation statement or they log into their online portal, a massive mistake they make is they confuse insurance with the costs of the superannuation fund. So you can get insurance through your superannuation fund. Most likely you get, death or life cover. I call it death because it kind of protects your family because you're dead, not because you're living. Another thing is for total and permanent disability, or TPD for short. And a third one is for income protection, to replace your income if you're sick or injured. When you've got a family or when you have responsibilities in your life, like a mortgage, a business, these types of things, having these types of insurances is so important. So important. We've done separate podcasts on this topic. These insurances can provide for your family when you're not around. This is why I say to people, before you change super funds, make sure you understand what insurance you have and if you will lose cover when you go to a new super fund. Because when you change super funds, you've got older and you've got probably more medical conditions, which you may never, ever be covered for again. So make sure you get good financial advice and at the very least, understand the insurance policy that you have and what you are or are not covered for to determine if it's worth it. Frankly, I would never change super funds ever until I've reviewed my insurance cover. Now, that said, as people approach retirement, what I find is that a lot of them still have a lot of insurance in their superannuation fund. If you ask me, coming into retirement is a great time to determine if you need insurance. But even if you're younger and you're choosing to kind of be financially independent, retire early, or one of the FIRE community members, or maybe you just have the option to retire early, review your insurance. Likewise, if you've done really well for yourself, you've inherited some money or whatever the case may be, understand if insurance is still necessary for you. I tend to opt for the side of conservative and I tend to have insurance just in case. The other thing that I'll say, and this is the last thing that I'll say about insurance, is you can just get insurance in your own name. I used to be of the opinion that it's really good to have insurance inside super, but only if you add extra money to cover the cost of insurance. You see, the thing is, when you put money in super, it will grow faster than money outside super because there's a lower tax rate. And so over your lifetime, the more money that you use from your super to pay for insurance, the more you're giving up in your retirement balance. Versus if you can just pay the insurance in your own name, like out of your own pocket, you just pay the bill every month or every year, you're going to be able to let your money inside super grow faster because insurance isn't eating away at the balance. So make sure that you weigh up the pros and cons of both options and how insurance can help you. We've done full videos and I'll put a link in the YouTube description and podcast player so you can get insurance advice from an expert that I know and trust if you want to go down that pathway. But let's just recap the 5 things on how to boost your superannuation step by step. Number 1, look at your fees and costs. Fees and costs are not everything, but it is important that you've selected the right, number 2, investment option. The investment option that most people go with when they're still generating money is to have more growth than defensive assets. But keep in mind, you don't want to freak out at the worst possible time. Everyone thinks they're a high growth investor until the next market crash. Number 3 is make use of the concessional contributions. This is that $30,000 limit that I spoke of. This is easily the best for pre-retirees to boost their super, but just be mindful that you don't go over the $30,000 cap. If you've got under 500K in your super fund, you may be able to use catch-up contributions. Number 4 is the government co-contribution. It's just a small amount you can add every year if you're in that income threshold, or maybe your partner has some money in your joint bank account, and maybe you might be able to use it that way. Make sure you check out the T's and C's. And number 5 is review your insurance. Don't change your super fund until you've reviewed your insurance, but also ask yourself, how much insurance do I need? And if I can have this outside of the superannuation fund environment. So those are my 5 ways to boost superannuation. And as you can see, it's really just about your education and knowledge, which if you've made it to the end of this video, you've done a fantastic job of understanding what it means to boost your super, what superannuation is. Don't forget, we've got a full free course. If I have missed anything, I'd love to know what I've missed. What are in your top 5? You can let me know in the comments on YouTube, or if you're on Spotify, be sure to use the question and feedback section as well, so we can read your feedback and do another one of these. Superannuation is by far the most important way to build wealth for anyone retiring in the next 10 years. So make sure you understand what you are and aren't eligible for. If you need financial advice, I think you should get financial advice coming into retirement. So therefore, I think everyone needs it. Get financial advice, shop around, make sure you consider all of the information that's available in your super fund's website and PDS. Thanks for listening to this podcast on the Australian Finance Podcast. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.